All right, good afternoon. Welcome to the session. It's my great pleasure to introduce Professor Karthik Balasubramanian from Howard University School of Business. Karthik is broadly interested in real-world optimization. He actually won a DBA from Harvard Business School, where his dissertation focused on the optimization of inventory management for mobile money agents in Tanzania, Kenya, and Zambia. Over the past 15 years, Karthik has conducted a lot of high-impact strategic analytics for the World Food Program, the American Red Cross, the Ohio Department of Rehabilitation and Correction, the Bill and Melinda Gates Foundation, and also corporate clients as a consultant with the BCG, and also many political campaigns. So he has done a lot of impactful work, very impressive. So I really look forward to hearing what he can share with us about this operations research on mobile-enabled financial inclusion and the roadmap to impact. Yeah. Thank you, Karthik, for coming here.
Thank you so much, Mabel. Really appreciate it. So yes, as Mabel mentioned, there we go. Is that better? Yeah, okay. Great. Yes, so thanks so much for the intro. Today I wanted to basically kind of give a big overview of the opportunities that exist with mobile-enabled financial inclusion. There are lots of operations research type topics, and I think there's a lot of space for folks to get involved and actually make a real impact in the process. So I've worked with a bunch of different folks on this work or on kind of pieces of mobile money work. Chris Parker at American University, David Drake at Colorado, Jason Achimovich at Penn State, and Gloria Uria at Indiana. And yeah, there's just kind of lots of, so those are also good folks to connect with as well if you're interested. So kind of broadly what I want to do today is just kind of talk about what the space is, kind of the opportunities that exist in the space broadly from a kind of a business context perspective. Then talk about, mostly spend time on inventory opportunities and kind of give a baseline of understanding of kind of what the inventory challenges are and what where there's space for innovation. Similarly, incentives as well within the ecosystem of mobile-enabled financial services, location, and then kind of other miscellaneous opportunities as well. So the big picture of mobile-enabled financial inclusion, about half the world's population, about 2.5 billion people, a little bit less now, but still a huge number of people, don't have a bank account. And the issue, and that's kind of particularly severe in sub-Saharan Africa and South America, South and Southeast Asia, lots and lots of folks that are completely disconnected from the formal financial ecosystem. And the problem with that is that when you're disconnected from the formal financial ecosystem, you're trapped into a physical cash-only world. And the problem with being trapped into a physical cash-only world is kind of manifold. One, this severely limits how fast money can flow and how fast money can move from one person to another. And that has knock-on ramifications all the way down the ecosystem. So even if you just look about transferring money, if you needed money in a pinch from family members, friends, or coworkers, and you happen to be geographically separated, and you don't have access to the formal financial ecosystem, that money can basically only move in one way, and that's cash. And that is very, very inefficient. And that is a severe drag on economic growth. It's also kind of a severe impacts on just people's well-being because oftentimes money is needed in a time-sensitive manner. Similarly, Similarly, when you've got a cash-only world, your savings options are also limited. So imagine if you needed to keep savings, which everybody does, imagine having to keep that not in a bank, but instead in some sort of physical asset. That might be cash under the mattress, that might be gold or livestock. All of these things are substandard financial instruments to keep people's money safe, because you could get robbed with cash under the mattress. You could have gold be stolen. Your livestock can die. And also, if you need that money in a pinch, oftentimes when you're saving in durable or physical assets, if you need to sell that, it's oftentimes at a loss. So it's, again, kind of very substandard savings instrument. And similarly, with credit, if you are locked into a physical cash-only world, again, you're geographically constrained to who you might be able to receive credit from. The only people that you'll be able to receive credit from are people that live geographically close to you, so that you can actually repay them in physical cash form. And that's really not ideal, because, again, like, you are totally disconnected from global capital markets. It doesn't matter, for example, that there might be someone who is across the country that would be willing to lend to you, or if you're actually a great credit risk and you have very high ability to repay. If you're stuck into a physical cash-only world, the only person or the only people that can lend to you are oftentimes the community money lender, oftentimes at much worse terms, high rates, short repayment terms, just, again, being disconnected. And then lastly, also insurance is an issue as well. So, we have any number of insurance products. So whether that's life insurance, health insurance, crop insurance, there's so many different types of insurance in order to mitigate risk. And in places where you don't have access to a bank account, you could actually make the case that people are even more susceptible to risk, and also they would benefit even more substantially from health insurance, life insurance, crop insurance, all of these different types of insurances. But the problem is, again, the economics of dealing with someone in cash, especially with a really small policy with these tiny premiums, doesn't make any sense to serve the poor with insurance options in cash. It just doesn't make any sense financially, so nobody does. And that's kind of all of the problems that are associated with being locked out of the financial ecosystem. Yeah, I think. Yeah.
Yeah, I had a question in terms of the understanding of the concept of insurance. I mean, I know that in India also, and I've had some exposure to it, to data that farmers, or especially smallholder farmers, the reason for one reason for low intake of insurance is the fact that they don't understand the concept of insurance itself.
Yeah.
So how does that come into play, like on the consumer side or the user side when it comes to interventions?
Yeah. So this is definitely, being locked out of the formal financial ecosystem is just one of many problems. I think, also just this, if you're in a population that has never, we get educated through marketing all the time. There are all of these different, every time a company wants to sell us something, they're educating us. So when we're searching for health insurance, they're telling us how they can use it and why they're the best. But if you are kind of deemed unprofitable, then there's no marketing that's going to happen. So basically, I think one thing that really needs to happen is for the cost structure to change such that it becomes kind of very compelling for companies to start serving. And in order to serve, you really need to educate. This is how, this is our policy, and this is how you can use it, and this is why it benefits you. The other point that I wanted to make is that oftentimes people insure themselves in a way. There's kind of this concept of informal insurance. We don't think of it like that, but when you fall on hard times, you maintain family connections for the value of family, but then also your family helps you and you help them. And similarly, your friends help you and you help them. And this type of informal insurance, everybody has, they might not think of it as insurance, but it definitely is insurance. The problem, though, again, actually coming back to this issue, is that if you are only self-insuring or you're insuring informally, your likelihood of being, trapped into a, correlated risk situation is high, especially if your family members all live in geographically concentrated area. If there's a flood, when you get affected, it's very likely that other people are affected. So just like you need money, they need money too. And that type of correlation is not good. And again, because you're constrained geographically, this is a problem. With global capital markets, for example, there's a zero correlation between, flood risk in let's call it rural Tanzania versus, global capital market and that's, being facilitated in London, for example. It doesn't matter. And that's kind of the beauty of pooling risk. So, but, when you're disconnected from the formal financial ecosystem, you have that issue. So these are kind of all of the main issues with being disconnected. But there's been a significant opportunity that has arisen with the explosion of mobile telephony in all of the places that we care about, in the global south or the developing world, kind of however we want to describe it. People who kind of otherwise are, kind of completely disconnected are now being connected to the internet, to their family, friends, neighbors, everyone, coworkers, job opportunities through mobile networks. So of the 2.5 billion people who don't have access to a bank account, an estimated 2 billion, this actually number is higher now, 2 billion do have access to a cell phone, or at least a SIM card, where they can keep that SIM card. The subscriber identity module is this kind of tiny card that you put into a phone that you can kind of make and receive calls, text messages, et cetera. And the smartphone penetration is also increasing very quickly. So now you can actually, use the internet as well from these phones. And it's a huge chunk of this population that also now has access to smartphones as well. Not required for benefiting from mobile-enabled financial inclusion or financial services, but it just opens up another complete avenue and opportunity as well. So anyway, this is mobile money growth. So what's happened is, on top of these mobile networks that have exploded all over South Asia and Sub-Saharan Africa, now pretty mature markets that have been around for 20 years now, there have been in certain places, starting actually in Sub-Saharan Africa, in Kenya specifically, and then kind of spreading to Uganda and Tanzania, and then other places in Sub-Saharan Africa, and kind of now all over, and I'll show a slide in a second. The operators, the mobile network operators, so essentially the equivalent of T-Mobile or AT&T or Verizon here, but in Kenya it's Airtel, it's MTN, it's Safaricom or Vodacom. These mobile network operators have started to, starting from 2007, have started to offer the ability to convert cash into electronic value and convert electronic value back to cash, and allow that money to be sent, much like an SMS. And those kind of transaction rails have enabled a lot of possibility. And because the need was so great, we saw explosive growth, because the options for moving money quickly were so limited, if existent at all. When there was something that a technology that came to kind of be present in their lives, it exploded because there was such a great need. for people to get have the ability to send and receive money. So mobile money has gone global. So in many places, among the most competitive mobile money markets in the world are in sub-Saharan Africa. But now, in places again where we would consider the developing world, there's huge amounts of competition in Mexico and South America, in sub-Saharan Africa, in South Asia, Southeast Asia. There are lots and lots of these mobile money deployments. So there are hundreds of mobile network operators who have started doing this because they've seen this kind of crazy rapid adoption of mobile money services by other operators. So this is kind of how a typical mobile money agent would look. So mobile money agents are kind of the backbone of the mobile money ecosystem. They exchange cash for electronic value and vice versa. So there are thousands, even in just one network, there are thousands of these mobile money agents. These mobile money agents oftentimes do something else. So they might be selling some kind of small shampoo or cooking oil or rice, but in general, they're relatively small shops. Sometimes they're dedicated in the sense that they only do mobile money. But if you've got, so here is an example of a Ugandan agent where they're selling kind of small foodstuffs as well, but they're small kind of 10 by 10 shop where they exchange cash for electronic value and vice versa. So this is how the system works. So if you're trying to move money from one place to another, before you'd only be able to move that money in physical cash form. But now with mobile money, the way that you'd move that money is, oftentimes there's, and actually in most countries, there's a significant trend towards urbanization. So people are leaving rural areas, oftentimes leaving their families behind to move to an urban area so that they can make money and send money home. So this is kind of this enabled money movement specifically for this purpose initially. They actually, in mobile money, the mobile money deployment in Kenya called M-Pesa, their tagline was send money home. That was their first killer application, or that was the killer application for mobile money. So Nairobi is the main city center in Kenya, so you'd have people who would come from Western Kenya or Northwestern Kenya or Northern Kenya, and they would come to Nairobi to earn higher wages, and then now have this, they would get paid in cash and they would need to move that money. So in the absence of mobile money, they would actually have to physically transport that cash. So either take that money on a bus by themselves or give it to a family member, a friend, or someone that they trusted. But for so many reasons, that's not optimal. But with mobile money, someone who gets paid in cash can take that cash to an urban agent, one of probably more than 1,000 in Nairobi, and that person would receive, the urban customer would receive electronic credit. Lots of names, electronic credit, virtual currency, e-float. It's a one-to-one conversion. So I give 100 Kenyan shillings to the agent will give me 100 Kenyan shillings back in electronic credit that would sit on my phone. So now that I have, and we'll drill into the dynamics of those transactions a little bit later. The urban customer now has that electronic float, or what we call e-float, or electronic credit, on their phone, which can be essentially texted to anyone who is on the same network. And in some cases, in some countries, off network as well, to someone who uses a different provider. That money goes immediately. So this is what's called a person-to-person transfer, or P2P transfer. That money goes to a rural customer, perhaps his wife and family in his native village, and that person now has money on their phone. Now that person can go to one of lots of agents, even in rural areas. There are agents, there are competitive markets where agents exist, where she can take her electronic credit and retrieve cash from this agent. There's a transaction fee here for the customer. Customer has to pay a little bit of money. So they, if they take 100 Kenyan shillings and want to cash out, this is what's called a cash out transaction, they might get 97 Kenyan shillings back. Similarly here, if I move 100 Kenyan shillings from in person to person, they might, that might cost a shilling there. And then here, the customer doesn't pay anything, but the agent needs to be compensated. So the mobile network operator actually compensates the agent here, and then the mobile network operator also compensates the agent on the cash out side as well. So these two transaction types, cash in and cash out, are kind of the backbone of the mobile money ecosystem. They are what we call bridges to the electronic credit world, and bridges to cash and vice versa, bridges to electronic credit and vice versa. So this set, and I should also mention this, you don't necessarily need to cash out. You can keep that money on your phone and you can use that as currency. That's happening less often because kind of a number of reasons, but still we don't have the type of merchant adoption that we would see here with a credit card, for example. So that money oftentimes will come back still out of cash, as cash, but in the future, this is where the world changes. The world completely breaks open when especially poor people keep money electronically. And the reason that they would do that is if it was easy to spend electronically as well. And one day we'll get there. And the reason for that, the reason why that's such a big deal, is that when you can move money electronically, you can keep money electronically, and you can move money electronically, that fundamentally changes the economics for every type of financial service that you can imagine. Savings, credit, insurance, all of these that we're basically shut out of right now because they're simply not profitable to serve, because cash handling costs a lot, because brick and mortar branches cost a lot. It doesn't happen. But when you can make these small payments at virtually zero variable cost, that changes the economics. So now insurance providers can collect micro premiums of 3 or 4 or 5 shillings at a time, and it doesn't matter. It doesn't matter. You're not sending someone out there to go and handle the cash. It's all electronic, and that's when kind of the world changes. And we can talk more about that. Yeah.
Yeah, I have a couple of questions to understand this the market better.
Definitely.
So first question, what is the density of these shops in urban areas compared to rural areas?
Mm-hmm.
That's question number 1.
Yeah.
Question number 2 is the flow of money typically from urban areas to rural areas? I'm guessing that's obviously the majority of the case, but I was wondering if there is ever a reverse flow of cash or the e-money from rural areas to urban areas.
Yeah.
So that's question number 2. And then the third question that I have, let me think about it. I think I forgot it.
We can.
But
you
how about
remember.
we start with these two?
Yeah. So the first question about density. So in urban settings, the agent networks are very dense. So it's not unusual for cities to have agents that are right across the street from each other or right next to each other. It's a relatively, aside from the capital requirements, it's a relatively easy business to get started. So there are a lot of agents. So in Nairobi, there are actually thousands of agents in Nairobi alone. In rural areas, the competition is less. You're not seeing agents kind of lined up next to each other, but you do sometimes see competition. There is usually in these kind of more mature markets, so in Kenya especially, in Uganda and Tanzania, even in kind of small villages, you'll have at least one person who's a mobile money agent, just because there is a demand. And where there's a demand, then there's profit opportunity. So that's kind of your first question. The second question was the money flow, the direction of money flow. So initially, in kind of when an operator is just launching, they will, and actually the Kenyan playbook with Safaricom and Pesa was they heavily pushed this send money home and remittance, internal domestic remittance use case. So there was significant cash in here. It's basically here in this case. So you cash in the urban areas and then cash out in rural areas. There's a lot of that. And it is actually still tilted that way. But now with the kind of a more mature market, we are seeing a lot more things. So we're seeing rural agents, so rural to rural transfers from one small village to another. We're seeing rural to urban transfers as well. We're seeing urban to urban transfers. So like that, and actually that there's an opportunity there as well when you're more balanced. When you're more imbalanced, it's a kind of a harder business to be in. But I'll talk about the inventory ramifications of this money flow direction because it's actually quite interesting and important. But that's a great question.
I just realized what my other question was. So for a typical person, say, working in an urban city, what would the frequency of sending money back be typically? Is it like a monthly wage scenario or a daily wage scenario?
Usually it's monthly.
Okay.
But it's kind of, what's nice here is that the ability to cash in is so easy. So it's not like they need to kind of go do go to some kind of remote area and then take some day off of work and go to Western Union or MoneyGram, stand in a huge queue. It's not like that. They can just, if they wanted to send money, they could basically any time. The only constraint, there is some, the pricing does incentivize batching a little bit because higher transactions have in general so generally there's a tiered structure. So from 0 to 100 Kenyan shillings, it's this much, and then 100 to 500 Kenyan shillings, it's this much, and in general that percentage goes down over time or goes down with the transaction size. But even at kind of relatively low, small transaction sizes, it's not cost prohibitive. Well, it really depends. Everybody has kind of their own use case. But there's not, other than the transaction costs, there's really not anything that's keeping people from doing this. That's a great question. So the cash-in, so there are kind of two major transaction types. There's a cash-in transaction where I give cash to an agent, that agent gives me electronic credit. Then there's this person-to-person transfer. And note, again, this doesn't need to be done on smartphones. It can be done on feature phones. Or when we say feature phones, it's non-smartphones, these kind of old Nokia bricks. And then the cash out is where I go to an agent and I will transfer my electronic credit to that agent, and that agent gives me cash back. So the customer pays for this transaction and the customer pays for this transaction. That cash out fee is split between the agent and the operator. So this is how the whole process works, but there's an issue among many in the mobile money ecosystem. And this is the crux of the inventory problem. So oftentimes when I go to an agent, I have cash, but if that agent doesn't have sufficient electronic credit, then they are stocked out. And that stock out prevents me from actually doing the transaction. Similarly, on the other side, when I've got electronic credit and the agent doesn't have cash, we can't do the cash out transaction. And that every time this happens, especially on the cash out side, when this when this happens, obviously it's an inconvenience to the customer, but it also degrades the faith in the process and degrades the faith in the system. So you can kind of think about this, the equivalent of this, as a human ATM, that take deposits. The reason that, for example, all of us, I'm sure, don't keep our money in the physical cash form. We keep our money in banks, and our money in banks is basically represented by by bits and our online banking screen, and we see we have X number of dollars in our bank account. The reason that we are not all rushing to go get it out is that we know we can get that at any point. We can go into a bank and we know that they will have cash. And similarly, we know that when we go to an ATM, we can get that anytime. So I feel comfortable leaving it at a bank. But, and similarly, our ATM uptimes in the US are over 99.9%. So it is very extremely rare for for us to go to an ATM and that ATM to not have cash. So that is kind of one precondition for people to feel comfortable keeping money electronic. Because if they feel like it's not possible to retrieve their money at whenever they need it, then they are probably going to go immediately to cash because they know that they have full control. So this is actually a big deal. This is one of the kind of big deals that need to be solved. Among many, this is not the only one, but among many, to really see that magic happen of people keeping money electronically. So over the course of a day, this is the mobile money agent's problem is actually kind of non-trivial. So if we have a mobile money agent, they need to make a decision about how much cash and electronic value to stock. Again, you can kind of think of them selling cash for electronic value and selling electronic value for cash. So they have this interesting dilemma of, okay, let's say I've got 200 Kenyan shillings that I need to split between cash and electronic value, and I need to make a decision about how to stock. So let's say I do begin the day. So blue will represent electronic credit inventory over time, and cash will represent cash is represented by this green line. Let's say they start with 100 units of cash and 100 units of electronic credit. So the first transaction in this case is a cash out transaction. So that means that the agent receives electronic credit, so their inventory goes up by about 80 shillings, and their inventory of electronic credit goes up, but their cash goes down. And so we have this linkage between sales of one good and inventory of the other. And this makes it interesting because you can have stockouts of without any external intervention for both cash and electronic value throughout the day because of this interconnection between sales of one good and electronic credit. Sales of cash become electronic value inventory and vice versa. So this question is, how should we stock in this case? That is kind of one fundamental question. How should an agent stock in the case where you have cash that can be converted into electronic value through the sales process and vice versa? How much money do we start out with each day? And then in the future, we'll talk about kind of opportunities to push this forward. But this is just kind of one just on the inventory side. But how do you think about your inventory policy overall? So what's interesting is that, kind of in the interest of time, I'll skip some pieces. But what's interesting is we can do a bunch of modeling, and we can think about this as a kind of a single decision DP. But there's a really interesting way to think about this that makes this problem much simpler. So let's say you've got three cash outs over the course of the day and 3 cash ins over the course of the day. So in this case, somebody has 10 units of electronic credit and they want 10 out. They want 10 units of cash back. In this case, somebody has 20 units of cash and they want to get electronic credit. So we'll call this cash demand green, and we'll call this e-float demand blue. So over the course of this, we've got 10 demand of 10 here, 20 here, and 20 here. So we've got 50 units of total cash demand over 3 arrivals. And then similarly, we've got 20, 10, and 10 of electronic credit. And we'll represent them as positive and negative for a reason, and I'll show you that in a second. But anyway, in this case, we could, if this was shampoo and toothpaste, we would be stocking, if I told you, deterministically, hey, this is exactly what's going to happen, we would stock 50 units of cash and 40 units of electronic credit. That's what we would do, because that's how much we're selling. But because we've got this kind of relationship between cash and electronic value, when you satisfy demand for one, you get the other. So you can actually potentially carry much less than 50 units of cash and 40 units of electronic credit. And specifically, there's one thing that we observe is if you take the running sum, or the cumulative demand, and then you take the maximum and minimum cumulative demand, it turns out that that's all you need to stock. You need to only stock 20 units of electronic credit and 10 units of cash, and you could satisfy all of the demand. So that type of recycling within agents is kind of a big deal, because now you can satisfy a lot more inventory, a lot more demand with much less inventory. You can satisfy all 90 units of demand with 30 units of inventory. And so anyway, we can define this these two numbers as maximum and minimum cumulative demand, and these we've got these stockout conditions that we can define, and we can define an underage cost for cash and underage cost for electronic credit. We can define a cost function, and then we get something would take first order conditions, and we get something that looks a lot like news vendor. So we can come up with this. We can come up with a recommendation for cash and electronic value as a function of the distributions of their minimum and maximum cumulative demand, and then some parameters. So the first one, gamma, is the daily cost of capital, and MC and ME are the cost of commissions, what they receive. So you can kind of think about that as the margin for cash and electronic value. So we can come up with these. This is kind of one way to think about this problem. It turns out to be like a kind of a nice, simple way to make an estimation of about how much someone needs to carry. And this actually turns out to perform quite well. We did a bunch of simulations, and it turns out that even when the cost of capital goes up, the simulation, even when the cost of capital goes up pretty substantially, all the way up to 200%, this heuristic, it's actually technically a heuristic, because, and if folks are interested as to why it's not perfect, I can explain that. But basically, it still performs quite well, and it's a much simpler process than actually kind of defining out the kind of the entire transition matrix for transitioning from one inventory state to another, and then actually solving the DP. So anyway, this actually turns out to work pretty well, both with kind of with simulated data, and then also from using historical data. But so we worked with an operator in Tanzania, and this is actually, I should mention, like, there are hundreds of operators. So operators are generally pretty open to working with you. If you're interested in this, like, you can, if you've got a good idea, if you have an idea about inventory management or facility agent locations, incentives, like, there are lots of opportunities to work with operators, and the data that you can actually get is quite granular. So there's a record that's created every time an agent wants to does a transaction. So a timestamp, who the agent is, who the customer is, how much money was moved, and how much commission was earned. And I should also mention, mobile network operators are very special in the sense that they not only kind of facilitate and operate kind of like a bank, keep a central ledger, but that they also manage the telephony aspect as well. So you could also look at kind of a social network, and also human mobility patterns as well. So it's kind of another kind of interesting aspect of these settings where you could combine financial data with movement data as well. Every time you are moving, the cell phone operator needs to know where you are. They need to know, what cell tower you're connected to at any given point. And so they actually store that. It's what's called HLR data, a home locator data, a home locator record, and also called detail records. That one record per every text, one record per every phone call. So you can also actually see people moving over the course of the day, and then you can also see their networks moving. You can also map their networks both geographically and socially. So there's quite a bit of really interesting data that mobile network operators can provide. Aside from the mobile financial data that we use here. Anyway, we partnered with a Tanzanian operator, lots of 37 million transactions, 6,700 agents, 2.7 million agent days to evaluate the heuristic, and it turns out that the heuristic does pretty well. Hindsight, so kind of the way to read this is, hindsight is if I knew perfectly what demand was going to be, then I wouldn't have any stock out loss, and all I would need to do all I would have to do is kind of stock the minimum I would need. So in the case of that 30 and 90, where we had 30 units of demand satisfy 30 units of inventory satisfy 90 units of demand, that there is a cost to that. So the full 100% bar represents all the commissions, e-float commissions an agent could have earned. All of these agents could have earned. So the orange represents the cost of capital, how much I need to be spending to have sufficient inventory. And then the red represents the stock out loss, so how much they didn't receive from customers because they didn't have sufficient inventory. So it turns out that if you look at agents' actual decisions, we need to make some assumptions in order to generate this. And I can talk more about the assumptions if people are interested. But if we have this historical data, what we can do is we can actually go back and look to see, okay, how would that heuristic, this net demand heuristic, perform, and it performs pretty well. Obviously not to the hindsight level because we don't have that kind of ex ante information, but it performs very well with the kind of relatively simple setup. So anyway, there are some limitations to the work that's been done and real important kind of opportunities to go forward. So one, we only look at electronic credit. So cash recommendations is something that nobody has, and we can, that's a significant opportunity. Because again, agents sell cash for electronic value and sell electronic value for cash. So the agents' lost sales, this is agents completely in isolation. So there's no overlap, or we don't look at competition at all. This is a huge, interesting area as well. 67, so this was back in 2015 with data from 2015. Now there's even more competition. So there are thousands of agents that you can actually look at their competitive dynamics, their geolocations, and how they're making stocking decisions. This is a significant, interesting question. And this is the most important unsolved question, is like coming up with the threshold policy. Right now, this work is based on just with the assumption that an agent is going to be rebalancing every day without fail at the end of the day, or at the beginning of the day. But that's not how, I mean, many agents can do that and would do that if they're pressed. But especially in rural areas where it's significantly harder to rebalance and go to a bank and exchange their cash for electronic value so that they can start the day with the optimal mix. Coming up with a threshold policy is that's kind of the gold, and that is a real opportunity. And you could put that into the field right away and it would have an impact. Yeah, coming up with a threshold policy. So probably something that would take an agent's historical demand, and then kind of look at kind of something below a certain amount. When my e-flip balance falls below, or when my cash balance falls below, this is when I should go and rebalance. That policy is a real opportunity to create. So I'll pause there before kind of. I'll pause there. That is kind of the one big chunk of inventory. Any questions so far about anything context-wise or? Yeah.
Are the transactions tracked in any way? I'm just thinking whether there's any potential money laundering issues here.
Which type of issue?
Money laundering issues here?
Great question. Yeah. So in fact, actually, what's interesting is that many central banks actually want people to start moving money electronically, because right now money laundering oftentimes happens in cash form, and cash is totally untraceable. So when we have mobile money, when we have money moving electronically rather than in cash form, you can trace the entire. You can see who received that money, when they received the money, by who, how often they receive money from that person. You can kind of trace that money flow in a way that you just wouldn't be able to otherwise. It's also interesting to central banks and governments as well, because once people start moving money electronically, the transparency is higher, but also tax receipts can be higher as well, because you can actually start to see people earning money rather than in cash form. There's an interesting anecdote in Afghanistan where police were starting to be paid for the first time in electronic credit rather than in cash, and they thought they'd got a raise because people, when they were being paid in cash, people were skimming off the top and then just giving them money. But now it was coming straight from the source, and they get more money because less people are kind of in the middle trying to take money from them. So, yeah.
I see. So the network does keep track of all these detail of the transactions.
Exactly. All the cash in and cash out transactions are traced.
I see.
Yeah. So, and that's that's one of the reasons why this context is quite compelling to work in, because you've got such detailed and granular data. So I think we're running relatively short on time. I will kind of hit a couple other pieces here. One is this concept of pooling. So we'll take this old example here, where again we look at cash in and cash out. We take the minimum and maximum cumulative demands, and now we'll add in a second agent with kind of this is a contrived example, but just to illustrate the point, that has the opposite timing-wise transactions. When you put those agents together, it turns out that you can actually satisfy even more demand with even less inventory, which is very cool. So in this case, like, you can satisfy 200 units of demand for 50 units of inventory, and that's something that we can look at. That's another kind of significant opportunity, because money is moving electronically. It's a significant opportunity, and also you can benefit from statistical pooling. We looked at some Zambian data. It turns out that that can really significantly decrease the working capital requirements for agents. And there are kind of 4 different opportunities to increase profit margins for agents in generally a pretty tough business. So yeah, this is a real opportunity as well. There is an opportunity so this is kind of looking at pooling centrally. There's also an opportunity of creating a marketplace for agents to start lending to each other. That is another significant research opportunity where because I can move money so quickly, if we can essentially kind of think about it like a transshipment problem. You can move money very quickly. So you just imagine one Walmart warehouse can kind of snap their fingers and have shampoo show up in another Walmart warehouse. That's the opportunity. Another set of opportunities for research are the incentive questions. So there are 5 types of incentives that are all ripe for research. So one, this agent needs to be, this first one, the agent needs to be compensated by the operator. Otherwise, they wouldn't do this transaction. The customer, so this is on the cash in side, the customer is giving cash to and converting that to electronic value. And the agent is converting that to electronic value. There is a cultural, just actually globally, we do not pay for deposits. When we give a bank money or when we give someone money, we don't pay for that deposit. But it still requires somebody to actually facilitate the transaction, so that still requires some money. Coming up with that number of how they get compensated in a simple to understand way, but then also one in which kind of incentivizes the agent to do it and incentivizes the agent to be stocked enough, but low enough so that there's also a compelling operator business case is important. So that's one set of incentives. Another set of incentives here is actually the pricing side on the customer. So how much money should they be, does it ever make sense to make them pay for electronic value transaction? It's an open question. Similarly, cash inside, it's an open question. Then the person-to-person transfer, that fee, that pricing is also very important. And in fact, actually, the reason that is such a big deal is that if that number is too high, then in some cases, we might even want to incentivize that to stay electronic. So maybe even having a 0 fee here might make sense, especially when they're moving money to a vendor. So for merchant payments, we really want to make sure that money moves, that people keep money electronically. So there's again pricing dynamics at play here. So also short-term versus long-term dynamic as well. Similarly, how much money the customer needs to pay for the cash out transaction, how much money the agent should be earning from the operator. These are also important questions. All 5 of these are important, interesting questions that can be looked at. And then lastly, the last big picture opportunity, and there are more as well. These are just 3 inventory, incentives, and location are just 3 of many. There are also behavioral questions. There are sociological questions, economic questions, lots and lots of questions. But the one more that I'll highlight is location questions. How do you optimally locate an agent? And in this case, it's also in a franchise model because the operators are just licensing the agents. The agents are essentially independent contractors. So you want, and this is an age-old franchise question of the operator wants as many agents as possible everywhere possible, but they want to make sure that the agents have a compelling business case. So if you license 2 agents who sit right next to each other, they'll cannibalize each other and might end up killing both of the agents over the long term, the short and long-term dynamics. But then also you do need, but if the market will support it, if there are enough transactions to go around, then you want those 2 agents. Maybe you want them kind of separated apart. Similarly, some operators have what's called float runners. They'll go and they'll help the agents rebalance, proactively help them rebalance. So there's a traveling salesman problem right there too, of like how should I go and route my people to exchange cash and electronic value sufficiently. There's a very neat, so like, there are rebalancing questions, and similarly, once you overlay this is something that hasn't been done yet, but I'm really excited for someone to do it, is overlay the mobility patterns of customers to agents as well, so that now you can potentially have a scenario where you can play matchmaker. Operator can say, hey, I know that on Fridays you go from one rural area to an urban area or vice versa in general. So what I'm going to do, and I also know that an agent is probably going to be based on their money flow and their historical patterns, is going to be running out of cash at this point. So what I'm going to tell you is, as the operator, this person will be running out of cash, and I can facilitate a transaction. If you before you leave the urban area, if you carry cash on you and go and give it to this agent, you can make this much money. And that is a really cool opportunity to basically, have customers embed customers in your operation itself, perhaps with a negative price, so actually paying people to do that. So that's a kind of another, again, like I kind of want to, if there's anything that you take away, like I want to impress that like there is very neat data. There's a lot of great data here that's geolocated and really rich data that you can use to answer some pretty interesting operational questions. So I think 1 minute. I've got 1 minute, but yeah, any questions?
Any questions from the audience? I actually have a quick question.
Yeah.
So the network is just like within a country, or is it international as well?
It's a great question. So in general, they're within country only, and it's because central banks want to control the money supply, and they're essentially need to be regulated as banks, or at least kind of banks in a light way. But there is opportunity, in some places there are significant money flows that go from one country to another, and also kind of people who commute like across borders. And in many cases, it's the same operator group. So Vodacom, for example, operates both in Kenya and Tanzania. MTN operates in like 15 countries in Africa. You really could operate centrally, and there would be a real economies of scale that would come from that. But right now, the main constraint is regulatory.
I see. And to manage such a large network, is security or safety an issue?
Yeah, so it's a great question. So there are two types of risk here. So there's the risk of loss, theft or loss from the agent. And unfortunately, that's totally borne by the agent. Then there's the central risk of like someone actually infiltrating the core banking system. That exists with everybody, with banks and telcos. It's a generic thing that we should all worry about always. So, yeah.
Thank you.
Yeah, I had a question about the adoption of this. Is there any variation demographic-wise, like in terms of, say, gender or age? Is it that women tend to use this lesser than men, or older people tend to use this lesser, or is it widespread?
So it's kind of there have been folks that have looked at this. So in general, this was adopted starting in urban, then to rural. So went from urban to rural, went from rich to poor, started with men and then went to women. So all of those, unfortunate, it's just first adopted by, people who have the most mobility, have everything already. But what's promising is that it proceeded down market very quickly. And in some cases, specifically on gender piece, it has opened up some real neat, some kind of real great dynamics where, in some places, women are totally tied to their husband to manage money and to keep money. But now, if you have, if you have a SIM card, you can manage your own money. You can have your own money, and you can, keep your SIM card anywhere. You don't need to be totally beholden to your husband. So it is actually some real form of financial empowerment in that way. So you can start to earn your money, move your own money without fear.
Any other questions from the audience? All right, yeah. Thank you very much, Kartik, for a great talk.
Thank you so much. I really appreciate it.
And thank you all for attending the session.